Where are you from?
India.
Where are you going? Thank you. You?
India.
Where are you going?
Oregon.
Thank you. You?
India.
Where are you going?
New York.
Thank you.
India.
Where are you going? Thank you.
India.
Where are you going?
California.
Thank you. You?
India. California.
Thank you. You?
America.
Thank you. Where are you going?
California.
You? Where are you going?
Indianapolis.
Okay, thank you. Where are you going? Where are you going? Where are you going? Where are you going?
To say that the United States has an ongoing problem with illegal immigration and its southern border is an understatement that has been going on for years running now. And while current non-farm job postings in the USA are in sharp decline, we learned this month that while the hiring of legal workers is on the rise, job holdings for native-born U.S. workers is on the decline. And just last month, August 2024, 665,000 immigrants, legal and illegal, gained a job. Meanwhile, 1.325 million native-born U.S. citizens lost their jobs. Since pre-COVID 2020, native-born workers have lost an estimated 2 million jobs, and since then, basically all the net job gains in the U.S. are immigrants, signified by the climbing red-colored line on this Fred chart here. The U.S. stock market sold off today on weak August jobs numbers, finishing its worst week since March 2023. Thus far in this month, September alone, over $1.78 trillion in value has fallen out of the current U.S. stock market bubble. Gold has only to date been outperforming world stock market indexes. We still await its further breakout in relative value versus the current U.S. stock market bubble. Currently, it still takes over 2 troy ounces of gold to afford the nominal S&P 500, but on a longer-term chart, a revisit towards the parity of 1 and below, akin to the 2011 gold price high, is likely later this decade, perhaps stretched into next. On the silver side of the relative value equation, we're still patiently awaiting silver spot prices in fiat US dollars to begin reacting to the bullish fundamentals with eventual momentum moves to the upside in price. In terms of spot silver versus the current US stock market bubble, we're still hovering around the second most elevated level of silver being relatively cheap to US stocks on a historic basis, and at least for now. For me, this chart suggests an eventual rollover in which silver outperformed the S&P 500 by a factor of more than 4 later this decade, as it makes its eventual way back to and likely beyond the old 2011 lows of this S&P silver ratio chart. Ole Hansen of Saxo Bank listed a few of his reasons for staying long-term bullish gold as follows. Gold supported by a global economic slowdown and a more aggressive U.S. rate-cutting cycle to come. Continued geopolitical risks with Russia, Ukraine, the Middle East, and the upcoming U.S. presidential election in November 2024. Continued strong retail demand for gold in China as Chinese look to park money in gold over its struggling economy and real estate sector. Rising debt to GDP ratios in major developed economies, spurring increasing concerns about the qualities of ballooning debt levels, and driving further rich individuals and family offices into record gold demand in Q2 2024 in the London over-the-counter gold market. Given coming rate cuts, the potential continued return of Western investor capital flows into unsecured gold ETFs, and continued record-sized central bank gold bullion buying ongoing. Considering that final point about record central bank gold buying, here's Indian CNBC covering the latest countries to admit adding to their official gold reserves over the last few weeks.
Manisha, it seems like the central banks are looking to pile on to the glitter as well.
Oh, well, yes, and why shouldn't you then? If you look at the global markets numbers, really, Hormuz, that tells you that the global gold ETFs are on being bought 4 straight months, if you count the month of August as well. And well, yes, the global central bank gold buying has been one of the reasons that the gold prices have continued to be where they are right now. Of course, add geopolitics and the fact that the US rate cuts are into the coming there. So when you look at the India's RBI as well, we have added 5 tons to the gold reserves for the month of July. And when you look at this current year, well, India's RBI has bought gold every single month in 2024, bringing that count really to around 43 tons. If you look at the overall India gold reserves, when it comes to gold reserves into the RBI, they stand at a tall 846 tons. So there has been a very strong buying that we have seen continuing. It actually has been 8 to 10 countries which have been constantly buying, including China, various other Asian countries, and of course within the UAE markets as well. The global central central bank buying has been on the stronger side, even as the gold prices have been hitting all-time highs there. So when you look at the month of July, it has been to the tune of around 37 tons. For the month of June, was at around 12 tons. So we have seen almost 200% of a jump up coming in there. Also, when you look at the first 6 months of the year that the global markets have bought gold, it has been at an all-time highs. In the year 2022 is when the global central bank buying was at an all-time high of 1,087 tons. 2023 saw a buying of around 1,037 tons, and in this year until now we've seen more than 500 to 600 tons being bought by global central banks. It still is 5-6 months remaining, and the expectation is that we could be looking at a higher number. Citi, Bank of America have put out 1,100 tons being bought by global central banks as an expectation for this year. So while continues to be a very strong one, it has been an active accumulation, whether it is about geopolitics, de-dollarization, or about increasing their reserves when it comes to gold, but it clearly seems to be helping the gold prices within.
Russia made gold news this week by declaring she is going to increase her gold buying this month by a factor of 7-fold over last month, August 2024. Russia is looking to move upwards of 172.9 billion rubles into gold bullion reserves this month, September. And while that sounds like a lot, it nets out to about 24 metric tons of gold bullion buying this month. That amount was typical during the Russian Federation's admitted monthly gold bullion buying spree volumes in the latter 2010s. This recent Russian declaration of gold buying has of course led many October 2024 BRICS summit watchers to speculate on the reasons for publicly declaring the nation's intentions ahead of time. But this kind of news and common gold knowledge is not only slowly spreading in the West. We're going to turn to Taiwan to hear how a common local gold jeweler talks about the current gold market drivers in 2024.
Back in mid-August, the price of gold hit $2,508 per ounce. 2 weeks later, it continued soaring to a fresh high of $2,527.
Jewelers say they expect the price to break past $2,600. The factors at play include trends for de-dollarization and wars in Eastern Europe and the Middle East.
As gold prices continue rising, consumer preferences are changing at jewelry shops. Last week, the international price of gold reached a record high of $2,527 per ounce. That's about 10,140 NT per Taiwanese mace, or 3.75 grams. Since 2017, the price of gold has taken a hit in the month of September. Will the September curse strike again this year?
Generally speaking, when there's a decrease in gold jewelry sales, it means buyers are probably opting for bars or nuggets instead. Some countries are considering de-dollarization, and China, Russia, and many countries in Europe are set to buy large amounts of gold. I think we'll see $2,600 per ounce by year's end.
The jeweler says de-dollarization is a factor that's pushing up gold prices constantly. In the past 6 months, the price of gold has shot up from $1,994 per ounce on February 15th to $2,527 per ounce on August 30th. Though the price fell back somewhat on Monday, an expert from the Taiwan Academy of Banking and Finance expects the rally to continue.
The U.S. Federal Reserve is expected to start a rate-cutting cycle in September and may lower interest rates by a full percentage point by the end of the year. This has caused the U.S. dollar to slide. Central banks are holding on to gold not as a short-term measure, but as a long-term holding. So foreign institutional investors are saying that if gold falls below $2,500 per ounce, it's a good point to buy in and not to sell out.
The Fed is expected to cut interest rates in September, a move that could drive the U.S. dollar down and gold up.
On the other side of this break, we're going to look at where in the West silver is threatening to already break out to new nominal record price highs in 2024, and how already well gold has performed versus the coming fiat Federal Reserve rate cut cycle to come. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Make some room in your safe because a whole lot of silver could be coming your way. SD Bullion's Monster Box Sweepstakes is back, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a monster box for the first time ever. This stunning silver coin is a highly detailed masterpiece featuring a hidden inscription on one of the tree branches that changes every year. So put on your best flannel and become one with the forest, and take your shot to win 500 silver trees from SD Bullion, because someone's gonna win it, so why not you? Click the link below for your chance to win.
The spot silver price sold off this week, finishing just below 28 an ounce bid, while the spot gold price sold off slightly to finish the week, trading just under 2,500 an ounce bid to close. The spot gold-silver ratio rose again on silver's relative weakness versus gold to a historically high level of 89 to finish this week. Given that a large amount of U.S. banks are still sitting on unrealized bond market losses, estimated still at nearly $500 billion at the end of Q2 2024 by the FDIC, it's most certain that they too are hoping that the coming rate cut cycle by the Fiat Federal Reserve might save them from bank bankruptcy and eventual receivership. And even in the face of raising U.S. interest rates, the spot gold price in U.S. dollar terms has climbed nearly by $1,000 a troy ounce since the final quarter of 2022. Think of this relatively recent strength in global gold prices happening already before it becomes obvious that the Fiat Federal Reserve has shifted its longer-term policy to heavier secular price inflation and fiat US dollar debasement to come.
Gold prices have surged over 20% this year, even as inflation shows signs of easing. This seemingly paradoxical trend can be explained by examining the third component of gold's inflation hedging ability: interest rates. Specifically, it's crucial to consider whether the Federal Reserve is raising short-term rates to combat inflation. Rising short-term interest rates generally reduce gold's appeal, as higher returns from cash and bonds make non-yielding gold less attractive by comparison. Conversely, falling rates often enhance gold's allure as a store of value, drawing investors away from lower returning assets. While price inflation generally leads to asset inflation, including gold, the Fed's interest rate policy heavily influences this relationship. Currently, the Fed isn't raising rates aggressively. In fact, the only debate surrounding interest rates centers on whether the Fed will cut rates slowly or more aggressively. This dovish stance has contributed to gold's recent rally, despite moderating inflation.
In bullion industry news, the Australian Perth Mint reported weaker silver and gold bullion sales figures continuing down under. Not surprisingly, given the real estate bubble going on there and the record nominal price highs for Aussie gold year after year, perhaps not many locals can afford gold. But it is the silver side of the equation in Australia I want you to focus in on to close this week. You see, the local price in fiat Australian dollars for silver is closing in on its all-time record price high already. And this is happening without scapegoated Hunt Brothers and or JP Morgan caught naked short on the COMEX circa late 2010 or early 2011. Rather, it's mainly bullish underlying silver market deficits and demand outstripping supply facts that are leading to inevitable new record price highs to come in Australia. It's estimated globally that from 2021 into the end of this year, 2024, the world has demanded almost a full year more of new lined silver supply than we were able to mine in a regular year, close to 800 million ounces more. And there's no sign of increasing industrial silver demand factors slowing ahead. Add in incoming investment demand when it whipsaws, and we're setting up for a rocket in price higher. So while I know personally waiting for the spot silver price in fiat US dollars to begin really reacting to these ongoing facts has been frustratingly slow to come, all one has to do is simply look over at the silver price chart down under to realize what goes on down under in gold and silver prices eventually comes around to the history's largest debt and promise-laden nation in time. That will be all for our weekly SD Bullion Market update. And always to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.